Hello everyone, and welcome back to the Surviving Retirement channel. Today we continue our chat on the multi-part series, How to Survive a Market Meltdown. In this particular segment, we're going to talk about one of the most critical aspects of investing in the stock market, timing. More specifically, we're going to explore what happens when you miss the best days in the market. The data might surprise you, and it's a powerful reminder of why it's essential to stay invested for the long haul. But before we begin, I'd like to give a shout out to First Trust Portfolios, who provided the slide you're about to see. Thank you to them and their efforts to educate folks about investing. My name is Peter Guidote, Chartered Accountant, Senior Portfolio Manager, and Certified Financial Planner. So let's dive in. This chart illustrates the growth of $10,000 invested in the S&P 500 index from December 31st, 1979 to March 28th, 2024. The difference between staying fully invested and missing just a few of the best days is astonishing. First off, let's look at what happens if you stayed invested through all the ups and downs. If you had kept your $10,000 fully invested in the S&P 500 throughout this period, your investment would have grown to over $1.5 million. This represents the total return of the market, including all dividends reinvested, capturing both the best and worst days in the market. It's a powerful testament to the power of compounding and the importance of time in the market. But what if you missed just a handful of those best days? Let's break it down. If you missed the 5 best days during your entire period, your investment would have grown to about $936,000. So missing just 5 of the best days over more than 40 years cuts your potential gains by nearly 40%. And it gets worse. If you missed the 10 best days, your investment would be worth only $675,000. That's less than half of what you have had if you stayed fully invested. Now let's take it a step further. Missing the 30 best days, your $10,000 would have grown to just $242,000, and if you missed the 50 best days, you'd be left with only $106,000. Missing the best 50 days out of more than 15,000 trading days would mean giving up nearly 93% of your potential gains. It shows just how critical those few high-performing days are to your overall returns. You might be wondering, why not just avoid the bad days and only invest during the good ones? Well, the truth is, it's nearly impossible to predict when these best days will occur. Often, the best days follow some of the worst ones, and trying to time the market can lead to missing out on those critical gains. For example, some of the market's biggest gains have happened during periods of high volatility, right after major declines. If you try to time the market by pulling out during downturns, you might miss those crucial rebounds. So, what's the key takeaway? Well, staying invested, even during the tough times, is crucial for maximizing your long-term returns. Trying to time the market is risky and can lead to significant missed opportunities. Timing the market involves getting 2 guesses exactly right every time, namely when to get out and also when to get back in. The data clearly shows that the cost of missing just a few of the best days can be enormous. As you have often heard us say, what matters most is time in the market and not timing the market. If you enjoyed this video, make sure to hit the like button, subscribe to our channel, and ring the bell to get notified of our latest content. And if you'd like to know more about us, check us out on survivingretirement.ca, or if you'd like to get a second opinion, book your free 30-minute strategy session with a member of our team using the links in the description below. Thanks for watching. Be kind to yourself and others, and I'll see you in the next video.